Welcome everyone to our December pitch day. For those of you who haven't joined us in the past, this is a great opportunity to hear from some of the active investment opportunities on FrontFundr, directly kind of from the founders and leadership teams themselves, and also a great opportunity to be able to directly ask them questions that you may have about the opportunity. So just as we kick things off here today, want to walk through a quick disclosure statement. Investing in exempt market securities is risky, so please refer to frontfundr.com for the campaign pages and the offering documents for these specific opportunities. This presentation may contain forward-looking information. There can be no assurance that forward-looking information will prove to be accurate, as actual results in future events could differ materially from those anticipated in such statements. Accordingly, viewers should not place undue reliance on forward-looking information. As we look to kick things off today, we've got a great panel of featured speakers. I'll be your moderator for today, Trieste Redding, the VP of Growth here at FrontFundr. I have the pleasure with working with many of these companies on their campaigns. Today, we do have an exciting slot of 4 speakers. Sam from KLMart has not joined the session yet, so I'm hoping he'll be able to make it today, and we'll be seeing his face shortly here. But we're going to be hearing from Dawn from Capital Direct, Malcolm from Valley of Mother of God Gin or Foxglove Spirits, and August from CPI Capital. So each company will have about 3 to 5 minutes to pitch, followed by a short Q&A. So definitely recommend any questions that you have for the companies, just add them to the Q&A during their pitch session, and we'll get to that as soon as we open the floor to the Q&A. So with that in mind, I'm going to stop sharing my screen, and I'm going to turn things over to our first panelist of today, which is Dawn. Dawn, over to you.
Thanks very much. Thanks to everybody for joining the call today. I'm just going to share my screen here. Thanks very much. Again, on behalf of Capital Direct, we'd just like to wish everybody a happy holiday season. We'd like to thank FrontFundr for the opportunity to get in front of everybody and just learn a little bit more about some of these great, exciting companies that are online today. So at Capital Direct, we are a mortgage investment trust. So you may have heard those, but we are basically a mortgage fund. We have a stable $10 unit value. So meaning that when you buy through us, for example, you buy $100,000, you come in at 100, you leave at 100, and you earn a rate of return on a quarterly distribution basis. So we generate quarterly income for investors. Capital preservation is key with us, and we hold that at $10. So again, for over 19 years now, people's original investment has stayed true and strong, and we've paid out a quarterly distribution since inception. We're now just over $602 million in assets under administration. Mortgages are predominantly residential. We have an average loan to value of 55.6%, so roughly 45% equity based or equity backed in people's homes. The portfolio holds securities across Canada. Our current loan size, our average loan size is 234,000. Our average payout is 17.8 months, so nice and quick. People come in, they go out and use us for what they need to use us for, and provide a great rate of return for our investors. Historically, our loan losses have been low since 2021. 2021, we had no loan losses. 2022, it was 0.01%. The next year again was 0.01%, and that was 2023. I believe that year the number was 48,000, roughly $48,000 in loan losses. And then the last year that we were audited, 2024, as you can see on the screen there, our loan losses were 0.11%. So all below industry average, but significantly below, and offering a great sort of return on your money without having to take a lot of risk through the loan loss side. Our fund performance, I'll just sort of show the last sort of 10 years roughly. If you look here, the current annual year that we're in, first quarter, we were 9.11%. Next quarter two, 9.12%, and then 9.01% in the last quarter three. Historically, though, this class of our fund since inception has done 7.83% since inception. So, obviously riding the sort of the current mortgages that are still coming off of the higher interest rate environment that we were in, sort of cycling back into the lower interest rate environment. But if you want to look back to like 2021, that was the lowest we have ever paid out, was 6.06% when rates were 0.05%. So that's sort of the floor, I think, of where we'd be. And we're probably sort of just coming off the ceiling on the 9.11%. So how it works with us is borrowers call into our call center. You may have seen our advertising across Canada. Capital Direct is pretty much a household name now, I think, on the lending side and through our sort of commercials. We basically advertise uh, on a fairly heavy basis just to make sure that we're in front of every loan. It's a very competitive space, so we probably turn away around 9 out of 10 calls that come in. So we want to make sure that we're in front of the best of the best. So those borrowers call in. They go into the Capital Direct Lending Corp. Now, not all mortgages are meant for the mortgage investment trust that we inevitably are talking about today. We do carve off some and have third-party investors investing in sort of those more sort of subprime type of mortgages, not sort of top quality. And then Capital Direct Management takes the best of the best loans, puts it into the Capital Direct Income One Trust. And that's what we have on the platform through FrontFundr for investment. And investors can invest into that income trust on a monthly basis. So the last day of every month, you can invest directly into that trust. The security position, roughly, it's about 62% firsts, 36% seconds, a sliver of thirds. Important to note here that we will never go, into second position behind anybody but the big banks, CMHC, or ourselves. That protects us, and the fact that we have the ability on the second side to buy out if we feel that a mortgage is getting into trouble. Second mortgage really allows you to control the mortgage, and we're able to buy out the first as long as we're sort of following who we follow in that line of first second mortgage originations. The locations of our mortgage, are BC and Ontario predominantly, 40% BC, 36% Ontario. Alberta has actually risen in the last sort of year. The ability of our advertising and the breadth of our advertising allows us to sort of turn on and turn off where we sort of attract loans or mortgage origination from. If we want to lighten up in Ontario, we lighten up the advertising. We don't get as many calls and more loans come from other areas. And so we've sort of felt that was sort of needed over the last little bit. We've lightened up on Ontario and increased our presence in Alberta. Like I said earlier, term maturity is 17.8 months, and our average loan to value is 55.4%, or sorry, 0.6%, leaving roughly 45% equity backed securities that we're lending against. I'll get back to that slide in a sec. But just in summary, why Capital Direct One Income Trust? We've got a 19-year track record coming up on 20 years in 2026 with a 7.83% rate of return since inception. We generate predictable, stable income quarterly distributions. You can reinvest through our distribution reinvestment plan. Roughly 60% of people do. Monthly liquidity. So we have monthly liquidity, and that allows us to, on the last business day of every month, give people their redemptions if they will. We do need 21 days advance notice, so it's usually within the first 8 to 10 days of the month that redemptions are open. But you do have monthly liquidity available on all registered plans, TFSA, RESP, RRSP, RRIF, and the first-time home savers buyer plan. Important to note that all redemption requests have been honored since inception, so for over 25 years, 20 years as a trust, and since 25 years as the company being founded. And again, also for those that are interested, we have full portfolio transparency. So basically, you have access to a full portfolio of loans, roughly 2,470 loans. So, our real secret sauce is the fact that we lend on a lot of loans with an average loan size of 234,000, so very small, and rolling through the portfolio every 17 and a half months. So that sort of leads me to maybe passing it back to you to have any questions from the field. Um, and I'll leave it here with our borrower profile because people may want to know who the average borrower is of a loan through Capital Direct.
That's great, Don. Thanks so much for the great presentation there. I know the profile of a buyer for the loan was actually on my mind there, so I'm happy that you're showing that at the tail end of the presentation here. But we do have some questions in the Q&A that I'd like to get to, and just a reminder for everyone to make sure you ask those questions now. We'll get through as many as we can. So we've got one from Howard here. What are the pain points you're addressing in the market? Maybe you could provide a bit more color on that, Don.
Sure. Well, you look at the marketplace and you look, I'll use BC as an example, but, commercial and development projects have sort of taken a back seat. There's a little bit of uncertainty with rates, on a sort of increase that we had about, a year and a half ago, really sort of slowed things down. The economy has slowed a little bit. So, if you look back though, and you look at our portfolio, um, the pain points are like, if somebody asked me what is, um, a year that might not be, uh, uh, sort of where we would maybe sort of look to the portfolio and say, okay, well, this is sort of where things sort of, really sort of show how secure our portfolio is. If we look back to 2021, I'll use in Canada, roughly, 2021 was sort of the height of COVID. Rates went to 0.5%. People's home prices dropped by roughly 20%. And we still were able to distribute a 6.06% rate of return. So that would be sort of the most pain that the marketplace could sort of lay into us. A market where you have decreasing property values, you have low interest rates, but we still managed to get through there with a 6.06% rate of return. So that would be sort of an example of pain in the marketplace and how it affects the portfolio. The rates would go down, but still paying out 6%, which is, above, sort of the bank's GICs and things like that.
That's fantastic. A follow-up question from Howard is for the use of funds or for the capital that you're raising, is that to deepen penetration in current markets or to expand into new ones? If the latter, which ones?
Yeah, so that's a great question. We're currently across, sort of four major areas, I'd say: Ontario, BC, Alberta, and the Maritimes. What we do through our advertising, like I mentioned in the presentation, is that we can turn it on and off in certain areas if we have concern. So if we have concerns in, what's happening in Southwest Ontario with the tariffs and things that are going on there, we can lighten up the advertising there. We don't get as many inquiries. We don't get as many sort of solid loans out of there. And what we do is we turn up the advertising in other places like Alberta, where we sort of see a little bit more sort of prosperity, a little bit more opportunity. And we'll increase our advertising there in order to generate more sort of opportunity to see what types of loans come in through our call center. So, I guess at the end of the day, what do we see right now? We see lots of opportunity in retail lending. We see, through more and more and more the banks being more and more difficult to being dealt with, and people coming to us for to fund a loan. We can fund a loan in 2 to 5 days. Whereas if you try to do it through CIBC or Bank of Montreal or Royal Bank, it's 2 months. So people come to us for quick fixes, and then usually either move off and go back to the banks or what have you. We're not the lender of last resort. We have in the portfolio we have interest rates uh, on originating on loans from anywhere from 4.95% to 29.9%. So, lots of variance there. Back to the slide of our average borrower. Our average interest rate right now is 10.26 in the portfolio, the weighted average interest rate. And you can see, that's sort of our average borrower profile. So, average credit score is 645. That's a great borrower. Lots in the 7 and 800s in the portfolio as well. But that's just sort of the averages across the board.
Fantastic. Well, thanks so much, Don. We are coming up on time here. I know there are still a couple questions in the Q&A there. So, Don, maybe you can take a quick look at those during the session here. If not, we can follow up with some email addresses after and make sure we get those all addressed. I think some questions on just the lock-in period for the investment. I know there is kind of monthly redemption opportunities, as
Yeah.
well as a little bit of what the returns might look like. But yeah, Don, great presentation today. Really appreciate your time and thank you so much.
Thanks for having me. We appreciate it, and we're happy to answer any of the questions that come in. Just on the lockup period, there is no lockup period. It's just more by prospectus, 6 months, or there's a penalty. But beyond that, we do have buys in and buys out or redemptions on a monthly basis. So thanks for the opportunity to get in front of everybody, and I hope you enjoy the rest of the presentations.
Fantastic. Thanks so much, Don. Like I said, we'll definitely follow up with some email addresses after just to make sure we get all those questions answered. So thanks so much, everyone. Now I'd like to turn things over to Malcolm to tell us a little bit about Foxglove Spirits and Valley of Mother of God Gin. Over to you, Malcolm.
Oh, thanks very much, Trieste. Um, so, as I would like to reiterate what Don said at the beginning and thank FrontFundr for this opportunity and thank everyone for joining us today. Um, my name's Malcolm Roberts, and along with my partner, Shelley Perry, we are the creators of Valley of Mother of God Gin. Pardon me, I've got a bit of a cold. So we're Canada's first luxury gin that aims to put our country on the global spirit stage in a way that really reflects who we are as a nation. Um, 7 years ago, Shelley and I, we were standing in the kitchen of our farmhouse with a little 5 liter copper still that we purchased from Portugal, and we were trying to answer one simple question: what should a Canadian gin taste like? There are lots of gins out there, and there are lots of Canadian gins, but we wanted to create something that could be recognized on the global stage. And what was that flavor going to be? So, as we experimented with botanicals from our farm, we have Macintosh apples on our farm, and we have black walnuts, we have the winter wheat that we're growing. Um, we experimented with botanicals as well as from across the country, and something became clear that the world admires Canada for its forests, its lakes, natural resources, but too often overlooks what really sets us apart is our talents and innovation and ambition. And we're seen as kind of humble and nice, but rarely as leaders in craftsmanship and luxury or global influence. And we want Valley of Mother of God Gin to change all that. So we had a very, very big ambition at the beginning that we wanted to create this luxury global brand. Um, Premium spirits are one of the fastest growing alcohol segments globally. That's premium, I'd say super premium spirits rather than premium. And consumers everywhere are trading up for authenticity, provenance, and craftsmanship. And where people often say, you hear people saying that people are drinking less, or they're drinking, alcohol. Is it reaching, is it changing the way people drink? It's actually changing very little, much less than you think. But what people are doing, they're trading up for better quality. So it's less about volume, it's more about quality. And that's where we are ideally positioned. So practically every luxury gin in this category comes from Europe and in the UK, as you know, traditionally, and other areas are now bringing in really excellent craft gins, especially in Japan. But despite Canada's, extraordinary or global reputation, we have no presence in this premium space. And here's the truth: Canada is one of the most admired countries in the world. And in many ways, people are rooting for Canada. And to finally have that kind of luxury spirits brand that reflects who we are, that space is wide open. So we created a portfolio that expresses Canada through craft and innovation, including our Maplewood Smoked Gin, which we have here. And this is a unique Canadian style that we developed from scratch. It took us 5 years to produce, to really bring it to market. We were uncompromising in our approach, and we won a master medal at the Global Spirits Masters in the UK, which is one of the highest honors in one of the world's top competitions. So it was a really strong validation for all that effort that we put into that. Domestically, we're in over 260 LCBO stores across Ontario, and we're scaling across the country. We are just listed in the #1 cocktail bar in Canada, and recently we were selected by Ban Lao, the #1 restaurant in Canada. I think it's number 12 in North America for their cocktail program. That was just a few days ago, which is huge validation for the quality of the liquid. Internationally, we're seeing really strong pull from Japan, where super premium gin is projected to grow at 34% CAGR, and as well as the Gulf region. And these are markets that really understand the value of luxury spirits and unique provenance. Shelley, my partner, can't be with us here today because she's actually in Japan right now launching our gins, and she's having fantastic reception. So it's more of it's the opposite of Canada. In Japan, it's about bars and cocktail bars and restaurants. Few people go out to, few people drink at home. They go out, and so really developing our gins in the on-trade with the bars and restaurants is critical, and she's seeing really amazing success right now. So we've done all this using a capital light, really highly scalable production model. We co-pack with a partner distillery in London, Ontario. We decided very early on that that was going to be the route for us. We have a beautiful bank barn here on the farm, which everyone's dream is to turn it into a distillery, but we knew that that capex involved in that was going to be would really weigh us down at the beginning. So when we started in 2017, we really spent 3 years developing the liquid and developing the packaging and developing the branding. And we launched in April 2020, right at the beginning of COVID. So it was a little bit of a very, very soft launch, I would say. We sat on our hands for a couple of years, and we really grew nice and steadily, but not with the trajectory that we were aiming for. There was no PR events, no liquid on lips, and no bars and restaurants to sell to. But we were successful. And so now we have the product, so we have the product and the story and the early traction. And the premium gin category is worth, sorry, the premium gin category is worth more than $20 billion globally. And it's continuing to grow as consumers are looking, as I said before, for elevated drink experiences. And Canada, as we said before, is admired around the world. In Japan, as I say, it's attracting huge attention, especially for the Maplewood smoked gin because it's so unique. But Canada's never really had that luxury gin that represents us on the global stage. So we've built an award-winning portfolio, proven strong traction at home, and we're now seeing really strong pull from international markets that understand premium craft spirits. And this is a tremendous moment to help share to shape what could become Canada's first true global luxury gin brand. And we would love you to join us on that journey. Thank you very much.
All right, Malcolm, thanks so much for the great presentation there. I feel like we're so familiar with the concept of like farm to table, and what's so awesome is you're truly like farm to bottle with the setup for the product there, which is so great. We do have a couple questions coming in from the audience that I do want to get to. Howard actually has been asking some great questions today, so I want to get to a couple from him. So Malcolm, quality/craft versus volume. Could you suggest impact on margin? How are you managing margin?
Yeah, margin is critical, obviously, and we are currently at 41% after excise, and for the Canadian dry gin, and we are 44%, almost 45% for the smoked gin. We've always been looking at bringing costs down. That's been critical to in our bottle costs, in our label costs, in our COGS overall. So we're currently, I think, in a really good position. If we were outside before excise, we're over 50% margin. In this industry, really, we're aiming for 65% to 70% margin. as we scale. And to get back to the earlier question, the uh, the balance of quality over volume is a tricky one, and we are uncompromising in everything we do as we launch this brand. So managing those reductions in COGS as we scale, that's has to be really carefully managed.
Absolutely. Another question from Howard actually is, can you talk further about expanding globally versus dominating local, the Canadian market, and how you plan to manage both?
Yeah, so we just signed with a really one of the Canada's largest agents, API, national agent. We were in Ontario for the first 4 years, and because Ontario is the largest alcohol purchaser in the world and one of the most competitive, for us, proving success at LCBO was going to be a calling card for other territories, other export markets, because everybody knows LCBO. And so we're number 10, we're number 7 in the top 10 luxury gins in LCBO. And all the other competitor brands in that top 10 are international global brands. So on the strength of our packaging, on the strength of our liquid, we're succeeding on a fraction of their budgets. So after the success really in Ontario, we're now expanding, scaling across Canada with our new agent. And that's important. And it changed a lot since the tariffs. We were looking at LCBO and as being such a key market, and then going into select markets in the US where we need to build volume. But with all the tariff issues just recently, it's still a little uncertain. So that opened up opportunity in Canada, across Canada, where people were really buying Canadian, really interested in Canadian products and supporting Canada. So we feel like we're in a really strong position as a brand that represents the whole of Canada, not just one small area. And internationally, we feel that the world just, the whole, as Bono said, the whole world is all of Canada. And we want to represent that. And so Asia Pacific market is growing rapidly. Other regions are growing rapidly quicker than the US. So we want to take advantage of that.
That's great. Thanks for answering that, Malcolm. We had another question come through from someone who says, "P.S. Fantastic product. They have several bottles." They're asking, what are the exit possibilities down the road or favorite option? Obviously, we can't be too definitive with that. We don't know the future, but I think in beverage, acquisitions are definitely a very common route from what we've seen historically. But perhaps you can talk us through just what those potential exit opportunities might be and kind of what the preferred path for the company may be.
Yeah, there are several opportunities. A strategic sale to a large beverage alcohol company is usually the path that most brands look for, or to a private equity company. We had a very finite goal when we launched this brand that we were looking at an exit, and our exit strategy is aiming at 5 years. And we know exactly how many the volume that we need to achieve that. The case sales, it's been worked back. The value of the case, it's usually in US dollars. So a value of a case could be 1,500, 1,000 to $2,000. Gone are the days with the Ryan Reynolds and the George Clooney's when they were doing, $6,000 a case. That's a 9 liter case. That doesn't exist anymore. But we are being really conservative, let's say, with $1,000 to $1,500 and looking at 50,000 case sales. So in this business, luxury spirits, looking at a multiple of 3x on revenue, or 10 to 12 times, maybe even higher on EBITDA. So all as Trieste said, very, very wide open playing field. But we do have a very, very fixed goal on where we need to achieve laying the groundwork for a successful exit.
All right, wonderful, Malcolm. Well, I think that's unfortunately our time for today. I know there are a couple other questions just about size of company in terms of revenue. So Malcolm, maybe you can have a quick look at the Q&A there. If not, we can certainly follow up with the attendee after the event as well. But yeah, thanks so much for the pitch today, Malcolm. Really enjoyed getting to learn more about the product and the company itself. So thank you so much.
Thank you so much, Trieste, and thanks for everyone for joining.
All right, and thanks to Howard. He just commented again. Yes, outstanding gin and brand story. Really appreciate the comments today, Howard. Next, would love to turn things over to Sam to tell us a little bit about KaleMart 24. So Sam, over to you.
Hello, everyone. Can you see my screen?
Yes, we can.
Perfect. So I'm Sam. I'm the CEO and founder of KaleMart 24. So I like to call ourselves the Whole Foods market of convenience stores. So basically, we reinvented the convenience store by bringing, nice products, modern like look and feel to the convenience store, to the community. We're the first convenience store that's really focused on better for you, natural food products. So this is an example of how our convenience stores look like. We kept all the classic categories of convenience stores. So we still sell like alcohol, lottery, tobacco, but all the other categories, so packaged products, ready to eat, personal care, or better for you products, natural products. So we took Nielsen data of Whole Foods markets basically, and took the best selling items in each category and put them in a small footprint. And so KaleMart 24 is born 2 years ago with the goal of really bringing those great natural products that millennials, Gen Zs are looking for to every corner in North America. So if you look at our assortments, we're really like, our main categories are the classic like packaged products, which are all natural, better for you. Then we have a big section of ready-to-eat meals, from salads, poke bowls, sandwiches, hot and cold, snacks, and like chia bowls, Greek yogurt, parfait, things like that. And that's like where our main revenue is coming from. So really bringing, like a better for you experience to the consumer when they're visiting a convenience store. So, because today, who wants to go to like a Circle K or Couche-Tard, to buy a meal? You only go there if you're stuck in a highway, in a gas station, and everything's closed, and you don't have a choice. So you grab like whatever they have there to eat. Whereas like at KaleMart 24, people are making it a destination, coming to our stores really for that food experience, getting those great items that you can't easily find anywhere else. And then we have a coffee and matcha counter where like customers can make their own coffee with premium organic Lavazza coffee. You can put your own like milk, they're like regular milk, vegan milk, whatever, and make it yourself. So it's a great experience for people. It's one of our top sellers, in fact, like the coffee counter. So people are really coming in the morning, lunch, dinner, to grab their coffee. We have a pet care section that depends on the size of the store and location. In some like locations where it's very residential with a lot of people having pets, like we have like larger sections, and then a personal care section. So all the classic items you would find in a convenience store for personal care, whether it's like condoms, creams, whatever, we have those items, but with the better, like better options that are more like natural, better for you. And what's really important for us was to make sure that everything we offer is aligned in terms of pricing to the classic convenience stores. So we made sure that every product we sell is priced competitively to what you can find at Couche-Tard or 7-Eleven. And, that was the main thing for us. And today we're really happy to say that, everything is really competitive in terms of pricing. So you get the same type of product, but with better ingredients, better composition, but at the same price. So if you look at the market, in general, like convenience stores are growing at a certain pace. They're still like one of the biggest retail industry leaders in North America, but the natural food space, which is like either Whole Foods, Trader Joe's, Sprouts, Avril in Quebec, for example, are growing faster than this classic convenience stores. But what we did is that we took the best of both worlds from like convenience and supermarkets to create Kilmart 24. So we're really taking advantage of the fast growing pace of the natural food space, natural retailers, and the majority of like retailers that are like convenience stores. So in terms of revenue streams, if you look at our structure as a company, we have two sources of revenue, so corporate stores and franchising. We're really focusing on our growing as a franchise. When we started the company less than 2 years ago, we started with 3 corporate stores. Now we're down to 1 corporate store. The other ones were franchised. And, as a franchise company, that's our goal, is really to grow through franchising, not focus on corporate stores. So we're not planning to open any more corporate stores moving forward, unless it's in a new region, a new place where we have where it's hard for us to find a franchisee. We will go for a corporate store just to penetrate that new market. And in terms of numbers, so for a franchise, the franchisee would pay $45,000 initial franchise fee, 5% of royalty monthly, and 1% of marketing. So in total, 6% of their gross revenue. And on average, our stores are having 45% gross margins across all categories, and a revenue of $1,300 per square feet. And we'll really target leases that are under $65 to be really like competitive in terms of expenses and the EBITDA. This is another example of how our stores look like. They're really modern, nice look and feel. They don't look like a classic convenience store. People really enjoy coming and shopping our stores. In terms of current locations, so far we have 7 open, 13 under build out, and in total we're at 16 franchise locations signed. So our locations look like this. This is like the first one that we built, Berry. Then we have Jari. This is a 300 square feet location. So we were trying really smaller locations versus more classic locations. So the smallest one is like around 300 square feet, whereas the biggest one is around 1,600. So we're really trying the 2 different models to see what works best. And we came to the conclusion that really we should focus on 1,000 to 1,500 square feet in terms of profitability. This is De La Montagne, our best performing store. This one is doing over 2.5 million yearly in revenue. 1,500 square feet, very strategic downtown location in Montreal. We have another 300 square feet, 400 with back store, Mont-Royal in the metro. We have some in Gatineau, Ottawa, in Bell Street, another one downtown. This one is in Laval, and the build out should open in January. Another one in Kitchener in Ontario, and in Pearl Street in Montreal, in the REM station of Eaton Centre in Montreal, and we have some more that are coming in Toronto and Montreal as well. So in terms of expansion plans, we've hit our target for 2025, which was 13 locations, all in Canada. We target to get to 300 locations by 2028, mostly in Canada, but also by growing in the US. So we already set up the company to be able to sell franchises in the US. We have a US entity that's owned by the Canadian entity. We have our FDDs, disclosure documents, franchise agreements ready to go in the US. And we have a lot of interest from single franchisees in the US, but we're looking for a group to really come and open multiple locations at once instead of dealing with franchisees for 1 or 2 locations. So that's why we're not like so aggressive in the US in terms of single units, but we're looking for more like multi-units type of franchisees. In terms of financials, an average store costs $350,000, which franchisees really love, because a restaurant today with the kitchen equipment and everything is closer to $1 million. So they can fit everything to build a Kelma 24 that you saw like look very nice and clean under the small business financing program, which is guaranteed by Canadian government at 85%. So really advantageous for franchisees. So instead of having one restaurant, they would buy 2 Kelmarts and make more profit after the 2 stores. 2025 projections, we're hitting them. So 13 stores, we're doing an EBITDA of $400K this year. And we're targeting 2027 to be at 10.8 million EBITDA with 171 stores. In terms of management team, so myself, Liana, and Miriam are in head office, but we have really interesting advisory board members. Adam Kozak was the CFO of Sol Cuisine, which was a public company that sold to Terrascent. So he's helping us with all the big financial decisions, really guiding the strategic financial decisions of the company. Lorenzo Di Nino was the category manager of Loblaws for natural food products. So he's helping us with all the tools that Loblaws used to use for selecting the products, making planograms, like the Nielsen data for Whole Foods markets, all this type of items. And Hafid Meswak was the director of food service at Kushtar. So he knows all the suppliers of Kushtar in terms of like, making ready-to-eat salads, sandwiches. So he helped us a lot with that to streamline our ready-to-eat operations. Yeah, this is a summary of what we do, and thank you for your attention. So Kelma 24 is really where wellness meets convenience, and we're, looking forward to your questions and answering your questions.
All right. Thanks so much, Sam. Appreciate the pitch presentation. Very detailed. We are kind of close on our time here, but do want to get through some questions here very quickly. Howard's been continuing to ask great questions all day, but Sam, he's got a question for you. Maybe you can drill down a bit on the market. Assuming a younger urban consumer, is there any research on average weekly purchase size and or number of visits? So maybe you can just give us more of an overview on kind of the market and the consumer, as well as, any stats that you may have on that.
Yeah, so on average, our stores have a visit of 300 transactions a day. And on average, those transactions are around $15. But it depends on the location. Like the location downtown where I am right now is in Montreal, close to the Bell Center, has more like 350 transactions with higher average, which is like more like $18 a transaction. So it really depends on the demographics of the area where we're open. We never tested yet the gas stations, but this is something we're going forward with because we know that traffic is very high in there. Depends on the location of the gas station, but we're looking for gas stations with high traffic, and we're excited to see what that's gonna look like. But with our offering, as I said before, like what's really interesting is the fact that all what we sell is really competitive with the classic convenience stores in terms of pricing. So it's not like it's not like stopping at Whole Foods markets versus Loblaws. It's really you're coming to Kelma 24, you're expecting the same prices as a Kushtar or Circle K. So a bag of Doritos that's $6.99 at Kushtar, we sell similar bag $6.99, but a better for you nachos that are like all organic, natural. So same thing, ice cream, Ben & Jerry's versus Hollow Top, same pricing, but less calories, better ingredients, organic certified. So that's really our advantage to those other classic convenience stores.
That's great. Thanks, Sam. Definitely love what you guys are doing and would hope to maybe see some locations out on the West Coast someday soon. One final question that would love to get to today very quickly, Sam, if you can, is just someone's asking if revenues are consistent year-round or seasonal. I know you're just opening a lot of locations, so you might not have that historical data yet, but maybe you can give us some observations of just what you've seen so far.
Yeah, so from the locations that are already open, like the seasonality is it's down in December in general because people are on vacation. December to mid-January, that's where we see like a difference. But other than that, like throughout the year, it's pretty like consistent. It spikes in summer in In Montreal, it spikes around June because there is like the Formula One. That's what we saw in Montreal. It really spikes in June. But other than that, across all stores, what we notice is really like mid-December to mid-January is very slow because people are on vacation, they're not going to work. And since we're in locations that are like more urban, like like in metro stations, train stations, like in high foot traffic, people are on vacation those times. So we see like the seasonality there.
Makes sense. Well, thank you so much for your time today, Sam. I know there is still one more question if you're able to answer that in the chat. For any other questions, you can always check out their campaign page, frontfundr.com/Kilmar24 as well. But yeah, thanks for your time today, Sam. Would like to now turn things over to our final presenter of today. We've got August from CPI Capital to tell us a little bit about their multifamily fund. So August, over to you.
Thank you so much, Trias. Thank you, the FrontFundr team, our guest speakers, and the audience here. Thank you so much. I'm going to be presenting about our CPI US Multifamily Fund Series A, but I thought it was very important for us to touch on CPI Capital, the company itself. The CPI Capital US Multifamily Fund is an arm of CPI Capital, the company. The company's been around for 6 years. We've done over $250 million of commercial real estate deals, and I've raised tens of millions of dollars from investors both in Canada and the US. Now, the fund is only for Canadian investors, particularly Canadian investors. So I just wanted to highlight CPI Capital itself, and the fund will have access to all the CPI Capital infrastructure and team members. As far as disclaimer and forward-looking statement, I'll leave that to our exempt market dealer. Management team matters, very important, right? If you're investing in a fund, a real estate fund, you want to know who's managing it. This concept of the horse and the jockey. So you want to see, you believe in the horse, let's say US real estate, but you want to make sure the jockey knows what they're doing. So myself, August Biniaz, Chief Investment Officer and Trustee of the fund. My partner, Ava Benesaki, the CEO and the trustee, and my partner, Paul Hopkins, VP of Investments. Jointly combined, we have over 50 years of experience in real estate. Myself, I've been in real estate for close to 20 years. I was a builder for over 10 years, and I've been with CPI now for 6 years. And my partner, Ava Benesaki, she was a real estate agent for over 10 years, and she's been with CPI from day one. And my partner, Paul Hopkins, our VP of Investments, he's got extensive background in real estate and construction. He's a civil engineer. He's worked on multi-billion-dollar bridge projects, and he's worked for a few private equity firms before joining CPI. So that's our team, just on a high level. CPI Capital US Multifamily Fund's mandate is allowing Canadian investors to have exposure to US real estate. Now, under the CPI Capital company umbrella, we syndicate commercial real estate deals, allowing investors to invest in those deals and partner with us. But those are on project-specific basis. They're syndicated deals where investors are investing in one specific project, be it multifamily, value add, or build to rent, which we'll get into in a moment. But the fund really diversifies investors and allows them to have exposure to every deal that CPI does, and some of the current deals that CPI has in his portfolio. Some advantages that the CPI Capital US Multifamily Fund has is there are no need for filing US taxes, even though you're making money in the US, bringing those money home without having to be double taxed, and there's an advantage there as well. But no need to deal with IRS. People are already, have to deal with the CRA. So last thing they want is deal with another tax agency. The fund is in Canadian dollars, so no need to convert those funds, and the distributions will be made in Canadian dollars. There are annual distributions via electronic fund transfer into the investor's bank account, very streamlined, and the management team we already spoke about. Some of the highlights of the fund. The fund, its anticipated life of the fund is around 5 to 7 years. We are planning to make this an open-ended fund, but at this stage, that's our current forecast. We're going to talk about other ideas in a moment here. Our target market in the US is Florida and Texas. Now, I don't want to prosecute Canadian real estate and the difficulties that exist here in Canada in investing in real estate, but as Canadians, we're sitting next to the largest economy in the world. U.S. has the highest rent-to-value ratios in the world, and the yields that the U.S. produces is higher than anywhere else in the world. That's why you have many institutions worldwide investing in U.S. real estate, particularly commercial real estate. For example, the Canadian Pension Fund invests in the U.S., partner with Greystar, the largest property manager and property owner in the U.S., to buy and build multifamily. So we're allowing retail investors and high-income earners to have that exposure and be able to invest in Florida and Texas with two different verticals. Why Florida and Texas? They check off our boxes: medium household income growth, population growth, rent growth, job growth, diverse economy, low crime, low poverty, in select markets that we invest in, and in sub-markets as well, and landlord-friendly, business-friendly laws that exist in the U.S., no rent control laws, and much less taxes on personal and corporate side. Our multifamily strategy is we utilize the value add strategy. What that means is buy a multifamily community, an apartment community, and we go in there and force appreciate it. How do we force appreciate it? We do renovations, we do upgrades, interior and exterior upgrades. In turn, we are able to increase rents. We upgrade the tenant profile. We do other creative items to increase income, like a Wi-Fi, when we get a hot Wi-Fi from a supplier, and then we sell it to our tenants. That's our value add strategy. Some images for some of the projects we've done, the upgrades on the interior on one of our current projects I wanted to share. Our other vertical is built to rent. We have partnered with a local developer in Texas, in San Antonio, and we're building purpose-built communities of rental communities. And these, particularly for our most current deal, Apollo Oaks, is a duplex community, 30 duplex community, 60 units, and we're building it from the ground up. So our investors will have exposure to both multifamily and our development deals. Some images of our current portfolio, both multifamily value add and built to rent. As far as the returns, the fund is forecasted to produce 15% average annualized returns over the term of the project. Now, 7% annually is the cash flow that gets distributed to the investors on an annual basis, and the subsequent 8% upside is distributed at a capital event, meaning that if we refinance the property or if we finish a development project and we exit that project, we divest it. Now the upside, those profits are now distributed to the investors. So we are forecasting for the returns to be 15% average annualized returns for our investors. CPI track record very quickly. This is Atlas at Bay Point, one of our multifamily value add properties in Tampa, St. Petersburg market of Tampa. Here's Blue Water at Bolton Landing in Charleston, South Carolina, Park Champion Forest in Houston, and Apollo Oaks. We were in Apollo Oaks at our groundbreaking last month. This is the 30 duplex project we're building. We're looking to continue building more projects in San Antonio and other projects, other areas in Texas, such as DFW. The team, and that's my presentation. Try to make it as quick as I could.
Thanks so much, August. That was a lot of great content to move through, so appreciate that a lot. What's great too is this is obviously not the first project that we worked on you guys with. I think what's so nice about this one is just that it is accessible to so many investors. I know past projects have come, with a $50,000 minimum for accredited investors. This is a very accessible entry point, $1,000 minimum investment. Retail investors are able to participate in this fund as well, which is great. So it's nice to see that. For any investors wondering as well, we haven't officially launched CPI Capital to the broader FrontFundr community. They've just been updating their OM. So we're looking to do that hopefully later this week, be able to get that announced to everyone here. So bit of a sneak peek for those on the session today. But do want to get through some questions. So I know, August, you just walked us through some of your past projects there. We did have a question, just kind of what are returns on past CPI Capital projects? So maybe you can just tell us a little bit about past projects so far, if you've been in kind of a position with any returns yet, or what investors might need to know about that.
Yeah, so on our two most current projects that we are working on, they have not been divested yet. So, but we're forecasted to achieve 15 to 20% average annual returns on our most current projects. So the fund is it's there. I mean, it has a 7% coupon, which is preferred return. So the investors have to make their 7% per year before the general partnership participated in any upside profits. So that's an extra level of security for investors. But yeah, that's briefly answering that.
Appreciate you explaining that. I think as well, you've walked us through some of the different kind of styles of investments you looked at, kind of the build to rent, the value add, as well as some regions. Maybe you can get a little bit more specific with kind of what criteria a property must meet to be considered for an acquisition, and how you kind of mitigate any risks associated with cross-border real estate investing.
Yeah, as far as our investment criteria, aside from the region, so Texas and Florida, hyper focus on Tampa and San Antonio. On the multifamily side, we're looking at 100 plus door apartment communities. They have to be in submarkets where there is growth, there is demand, low vacancy. The property itself, it needs to have a need for renovations and upgrades. We don't buy brand new properties, for example. The yields are much lower there. Some public REITs do, but we want to go in and force appreciate the property. So we buy 80s or newer properties. So we're going to be 80s, 90s, early 2000s, where we can go in and put in washer dryers, go in and do some upgrades and renovations, update the exterior, put in a better property manager, on-site manager to bring up the demand for rentals, and that's our strategy on multifamily value add. I mean, everything really spawns from the LP economics, the investor returns we're trying to achieve. So we have hundreds of deals that come through our database, and we underwrite those deals, analyze it. If they check off all of our boxes, we want to see if we can achieve the investor returns from what the deal is being offered at. So that's probably the more difficult part, is getting the deals to pencil. On the development side, we have partnered with a developer in Texas, in San Antonio, who's been building these purpose-built communities, purpose-built rental communities for the past 25 years, quarter century. So we trust in their process. And the strategy there is really the deals that come in their inbox, and they look at, they present it to us. And if it makes sense for CPI, we cherry pick the best deal that they have, and we end up partnering with them and create our own syndication for those deals. The sweet spot there is approximately 30 to 60 duplexes. It has to be, in the MSA, close to the center of city. There has to be obviously lots of jobs available. The median household income has to be reasonable to support the rental that we are asking. So those are some basic high level.
Fantastic. Thanks, August. One kind of final comment or question I want to get to today. I know obviously you're dealing with properties in the US. You guys certainly do a lot of due diligence and going to kind of check out the locations, and I know you spend quite a bit of your time in the US as well. So maybe you can just tell us, when you're in the process of kind of acquiring a property, what that kind of process is for you guys, being on site and evaluating those options and things like that.
Yeah, no, of course. I mean, we used to be market agnostic, and that's why you saw on our track record, we have deals in Houston and in the Carolinas. However, we're hyper-focused currently on Tampa Bay and San Antonio. We know those markets well. We know all the brokers. We know about what areas we want to be in and what parts of that MSA we don't want to be in. So when a deal comes in and it checks off those initial boxes, then we go in and look at the property, look at the current tenant profile. What is going to be our strategy to go in and renovate? Can we push rents? Is there a possibility to be able to push rents even if we do the renovation? Sometimes rents are so high relative to what the current market rents are. We see that even if we renovate and we spend a bunch of money on renovation, we're not going to be able to push the rents to where we want it to be. Yeah, that's how. It's not as if a deal comes one day from Arizona or another day in Florida. We're very focused on our market, so we know those markets very well. But we still have to kind of look at a deal and look at the market it's located, what part of town it's located in, and see if the deal makes sense. So that's how we de-risk the deal and bring the deals home for our investors.
All right, fantastic. Well, thank you so much for that great presentation, August, and for answering all those questions. Really appreciate it. As I said, look out for our launch announcement later this week with CPI Capital there. Very excited to get them up on the platform. And thank you to all of our presenters today. It was so great learning about each of your companies and the investment opportunities that exist. If you didn't have a chance to have your question answered, or you think of a question later, feel free to go to their campaign pages and directly ask them a question. We did also record the session today, so we will send out the recording of this as well to all of those who attended. So thank you everyone for your time. Wishing you a happy holidays. This will be our last pitch day for 2025. So great to see you all. Thank you for all the great questions, and yeah, enjoy the holiday period. Thank you, everyone.